Welcome to Beyond the Comfort Zone Talking Shit with KING-KAMBUF.
We're diving right back into it.
We are. Today we're pulling apart the reserve of KAMBUF Financial News and Reports magazine's latest, specifically the weekly Market Digest and Investment Analysis.
And this is the daily report edition for Tuesday, December 9, 2025.
And the timing on this couldn't be more critical. The market is, it feels like it's holding its breath.
It is. You can feel the tension. We are perched on the absolute edge, less than 24 hours away from the Federal Reserve's, well, their monumental rate decision.
Right.
And the source material we have in hand from the KAMBUF Reserve, it just captures this tension perfectly, this dichotomy of fear and, extreme opportunity.
Okay, so let's unpack that right away. Our mission today is not just to read you the headlines, it's to give you the framework, to understand how professional capital actually navigates this kind of uncertainty.
Yeah, this pre-event anxiety.
Exactly. The market is in this really critical mixed state right now. So our job is to go through the market scoreboard, figure out where the institutional capital is hiding, where it's flowing.
And crucially, translate those very specific, actionable trading signals from the proprietary KING-KAMBUF strategy.
Right, into usable, practical knowledge for you.
To do that, we're synthesizing insights from two absolutely core documents. First up is the main Financial News and Reports magazine. That gives us the macro landscape.
So the big picture. Sectors, volume, the main story of the day.
Exactly, the defining market narratives. But the second piece, and I'd argue it's the most vital piece, is the KING-KAMBUF 20-plus trading analysis guide.
And KING-KAMBUF, just as a refresher for anyone new to the KAMBUF methodology, that stands for the Technical Kinematic Investment Framework for Equity.
It's their high conviction momentum index. It's designed to just systematically track and trade the fastest moving, highest quality trends in the market.
So that's where the rubber meets the road.
That's where it all happens. That KING-KAMBUF analysis is where we find the really specialized intelligence. The defined risk parameters, the precise entry and exit points, and those high-confidence stock selections.
So it's a unique opportunity, really, to see how a professional, disciplined strategy adjusts its sails right before a huge binary event, like a Fed decision.
They're tightening the screws, defining the risk, preparing for what could be some really rapid movement tomorrow afternoon.
All right, let's start right where the market closed. On Tuesday, December 9th, the final scoreboard, it tells a very conflicted story. It's a classic waiting on the Fed kind of day.
Absolutely, and it's characterized by this deep sector divergence. The headline news was really the noticeable drag on the oldest index.
The Dow Jones, yeah, it underperformed pretty significantly. It finished the day down, about 0.4%? Closing at 47,649.92.
And that underperformance was immediately traceable to a single massive anchor.
Financials.
Financial sector weakness, yes. Specifically, J.P. Morgan Chase, a cornerstone of the Dow and, the entire banking system.
Their shares just got hammered.
Plummeted. A massive 4.7% drop on the day.
That is a phenomenal move for a blue-chip behemoth like JPM. It signals something deep, right? Not just a minor wobble.
It's pure forward guidance fear. J.P. Morgan issued projections that their 2026 operating expenses could exceed analyst expectations by roughly 9%.
9%, wow.
In the world of banking, that news is toxic. It really is. For two main reasons. First, higher than expected expenses, they just immediately translate into margin compression.
So their profits get squeezed.
Right. Banks rely heavily on operating leverage. So if your fixed costs rise unexpectedly, it eats directly into your net interest margin. You're in, and, therefore your profitability.
So it's not just a JPM problem then. It sends a tremor through the entire financial ecosystem.
Precisely. Because JPM is seen as the benchmark, right? The gold standard for operational efficiency. So if they are forecasting a 9% expense bloat,
the market assumes everyone else is in trouble too.
Immediately. It extrapolates that fear across the entire banking sector. It suggests the cost of doing business, maybe hiring tech talent, regulatory compliance, just inflation. It's all higher than expected. And that pressures the entire financial sector and drags the Dow down with it.
But here's where it gets so fascinating, this bifurcation. That weakness did not spread across the board. The growth engines, mainly tech, showed incredible resilience.
Remarkable strength, yeah. The Nasdaq Q Composite finished slightly up. It gained 0.18% to close at 23,588.53.
And the S&P 500 basically finished flat. a marginal gain of 0.09%, closing at 6,852.51.
And that small, mixed movement tells you everything you need to know about where capital is parking itself. It's not a full-scale panic exit.
It's a rotation.
It's a rotation. Capital is fleeing those traditional rate-sensitive financials, and it's seeking shelter in the perceived secular growth story of tech and AI.
Tech is still the engine.
It is. It's the relative strength engine, essentially decoupled from these old economy concerns about margin and expense control. This is the definition of the holding breath narrative.
So institutions aren't selling their winners, but they're cutting the fat.
Exactly. They don't want to sell their conviction growth stocks ahead of potential Fed accommodation, but they're absolutely de-risking the parts of the portfolio that are most sensitive to these margin and expense fears.
The report itself notes this incredibly narrow intraday range action. It's almost surgical.
It suggests traders are just unwilling to put on any new significant risk 24 hours before what is, let's be honest, a binary make-or-break macro event.
Right. Sideways movement means everyone's already placed their bets.
Or, more accurately, they've reduced their exposure to the bare minimum before the gravity of the Fed decision just takes over everything.
Let's talk about that gravity. The critical catalyst dominating strategy this week, they all converge tomorrow. We have the Fed decision, the conclusion of their two-day policy meeting.
And the market consensus, the expectation that is baked into every single stock price right now, especially in growth, is a rate cut.
Right. The source material points to a likely 25 basis point reduction. That's the baseline.
That's the baseline.
So if the cut is already priced in, where is the real risk factor? Where's the volatility hiding?
The volatility is hiding entirely in the forward guidance for 2026. And most critically, in Fed Chair Powell's press conference at 2:03 p.m. Eastern.
It's always what he says, not just what they do.
Always. The market isn't asking if they cut. It's asking how aggressive the easing path will be for next year. If the Fed tempers expectations, say, they guide for only 2 cuts next year when the market is priced for 4.
Oof. Even with a cut tomorrow, that could trigger a big sell-off.
A substantial correction. Especially in high valuation equity, particularly tech. The market demands validation for its optimism. It needs to be told it was right.
And we got a very relevant piece of economic data yesterday that kind of gives the Fed some wiggle room, some optionality to be cautious.
You're talking about the JOLTS data, the Job Openings and Labor Turnover Survey.
Yeah, it showed that job openings actually ticked up a little bit to around 7.1 million.
And this is a massive nuance. The market needed to see the labor market weakening decisively to really force the Fed into an aggressive easing posture.
But 7.1 million openings isn't a weak labor market.
Not at all. It reinforces the still okay labor market narrative. It says the economy is resilient, not collapsing.
And if the labor market is resilient, the Fed is under less pressure to slash rates rapidly.
Exactly. It gives them the breathing room to temper those aggressive rate cut expectations we just talked about. If the labor market were suddenly collapsing, the Fed would have no choice. They'd have to signal a rapid easing path.
But it's not. So they can afford to stay cautious.
Data dependent, which is the primary source of uncertainty for growth stocks that depend on cheap, abundant money.
And beyond the macro policy, we also have these huge corporate events this week that are critical for the KING-KAMBUF strategy's core holdings. We have Oracle reporting on Wednesday and then Broadcom on Thursday.
And these are not just any earnings reports. They are high-impact stress tests for the entire semiconductor and AI ecosystem.
So Oracle will give us a read on corporate spending.
An immediate read on enterprise spending velocity through its cloud and AI segments. But Broadcom is the heavyweight.
The big one.
As a major chip and infrastructure player, its guidance on semiconductor demand, its order books, its inventory levels, it would either validate or incinerate the momentum trades we see in the KING-KAMBUF index. These reports are the tactical validation points for the entire thesis.
Let's shift gears now to a topic that the KING-KAMBUF report highlighted as maybe the single greatest source of latent risk in the index, and that's market concentration.
Oh, yeah.
The numbers they detailed around NVIDIA's weighting are, they're extraordinary.
This is where we start talking about stocks and we start talking about market physics, gravity. We need to be crystal clear on the magnitude of this. NVIDIA alone now accounts for 10.1% of the S&P 500 market capitalization.
10%. A single company. We've had concentrated markets before. You think back to Microsoft or Cisco at the peak of the dot-com bubble.
Sure, but to have a single stock driven by a relatively nascent technological shift, like accelerated computing, commanding over 1/10 of the entire index cap, it's staggering.
And the risk just multiplies when you zoom out. Right.
It does. If you look at the top 5 companies, so that's NVIDIA, Apple, Microsoft, Amazon, and Walmart, they represent approximately 35.3% of the S&P 500.
A third of the index in 5 names. So why does this matter so much for you, the investor, trying to make sense of this?
It matters because of index mechanics and velocity. When a stock holds 10.1% of the index, if that single swing factor, NVIDIA, moves 5%, it pressures the S&P 500 by over 50 basis points by itself.
Regardless of what the other 499 stocks are doing.
Exactly. This concentration, it acts as a massive risk accelerator on the downside. But, it's also been the sole driver of index gains on the upside. It means you're not trading a diverse economy anymore.
You're trading a handful of mega caps.
You are. And that makes the entire index fragile to single company risk, to earnings disappointments, or sudden geopolitical shifts impacting their supply chains.
It effectively removes that historical diversification benefit you expect from an index fund.
Absolutely. The T-Kite strategy is well aware of this. They trade these stocks precisely because they drive the index. But they do it with rigid, defined stops, recognizing the existential risk this concentration presents.
So let's look at why they've earned that weight. Let's review the year-to-date leadership, framing the current environment throughout 2025. What's defined the returns?
The big picture is just pure technology dominance. The tech sector is way out front, delivering returns in the low to mid 20% range. It just reinforces that core thesis that growth is superior to value in this cycle.
But it's not just tech, is it? There are some other leaders.
No, it's worth noting the secondary leaders. Utilities and communication services have also posted strong double-digit gains.
Utilities make sense. Defensive, stable yield ahead of rate cuts.
Yep. And communication services, even with Tuesday's drop, reflects the secular dominance of digital advertising and streaming.
But the real adrenaline, the real rocket fuel, came from the deep infrastructure engine powering AI and data centers.
Oh, absolutely. The report highlights the top YTD S&P performers, and these are truly parabolic moves. It shows the market isn't just rewarding big tech, it's rewarding the fundamental plumbing that enables it.
Let's hear the numbers.
Okay, check these out. Western Digital WDC up 217.21%. Robinhood Markets H-Hood up 263.55%. Seagate Technology STX up 217.3%. And Micron Technology MU up 278.3%.
So WDC and STX, that's the memory and storage story. The market is aggressively repricing the fact that AI doesn't just need fast chips.
It needs exponentially more and faster data storage capacity. They're moving from being seen as legacy hard drive makers to crucial high-speed flash and NAND providers for real-time AI processing.
And the inclusion of Robinhood in that list, up over 260%, that strongly links this bull market with renewed, significant retail speculation, a big risk-on signal.
It shows the ecosystem is healthy enough to support both institutional core infrastructure plays and these high-beta, retail-driven platforms. It's an indicator that fear has been largely absent throughout 2025.
And how did the core Magnificent Seven, the established giants, fare within that context?
They delivered solid but pretty varied results. It reflects a bit of consolidation after their huge early runs. Alphabet GOGL led the pack with YTD gains of 67.9%.
Showcasing strength in AI monetization.
And that's advertising, though, yeah. NVIDIA had a more moderate gain of 30.2% YTD, which reflects that consolidation period after its massive ramp-up. And then Amazon AMZN was just kind of treading water, up 5.0%. The consumer cloud story is still constructive, but it's just less explosive than the pure AI infrastructure plays.
Okay, let's snap back to the immediate tick-a-ninth snapshot. Given the JPM shock and the pre-Fed jitters, we saw a really distinct sector rotation. Where did capital exit? Where did it land?
The weakness was definitely concentrated in those cyclical areas that would suffer most if JPM's expense fears translate into tightening financial conditions. So we saw communication services fall 1.8%, materials dropped 1.7%, and consumer discretionary declined 1.5%.
Why communication services? That seems a little counterintuitive if tech is strong.
Well, if the market anticipates a margin squeeze in the financial system and a potential softening of the economy, capital pulls back from areas linked to broad advertising spend.
Ah, okay. Ad budgets get cut first.
Exactly. Communication services often houses media, ad tech, and streaming giants that are sensitive to both tighter credit and corporate ad budget cuts. Similarly, consumer discretionary and materials are highly cyclical. They suffer immediately when credit is perceived to be tightening.
So the money flows out of cyclicals and financials and lands where?
It was a very clear rotation into defensives and selective, high-conviction tech. Technology was strong, gaining 0.9%, which is a clear institutional vote of confidence in the long-term AI growth thesis.
And the immediate flight to safety.
Landed right in healthcare and utilities. These sectors outperformed as the classic defensive choices, the places where essential services and inelastic demand provide insulation ahead of a big binary event like the Fed.
My takeaway here is that the market is showing a highly calculated barbell strategy in real time. It's a partial flight from the cyclical sectors, tied to the financial system.
And it's heading directly into two extremes.
Exactly. Deep defensives on one side, and the most promising segment of growth, which is selective AI tech, on the other. The caution is hyper-focused on margin and valuation in the broader market, but the faith in that long-term AI secular growth is it's fundamentally intact.
To really gauge the market's internal psyche ahead of the Fed, we have to look beyond just the price action. We have to analyze volatility and volume. If we start with the VIX, the volatility index, we saw it close at 16.93.
And for you, the listener, the VIX is often called the fear index. It measures the market's expectation of 30-day volatility. So what does a reading of 16.93 actually tell us?
It signals moderate, controlled, implied volatility. This is so crucial for strategy. A VIX of 16.93 means traders are balanced. They're not panicked. That would be 30 plus. But they're not fully complacent either, which would be sub 12.
So it's the sweet spot for anxiety.
It is. It's typical for a period right before a policy announcement. It shows high anticipation, but not widespread systemic fear. Think of it like this. We're not facing a hurricane, but we've certainly got whitecaps on the water. Everyone is strapped in expecting a bumpy ride.
And we can actually quantify that bumpiness, right? What's the practical implication of that 16.93 reading?
It implies an expected 30-day S&P 500 range of approximately 4.9% from current levels. So the options market is anticipating a normal, active trading environment over the next month.
So it's a move, but not a catastrophic collapse.
Correct. The VIX level is adequate for pricing protective strategies like hedging collars, but we know it will spike immediately if Powell delivers unexpectedly hawkish guidance.
Let's shift our attention to the volume, because the list of most active stocks on December 9th tells this compelling story of a fractured market. You have sophisticated institutional action coexisting with just wild retail speculation.
Absolutely. You see two very distinct tiers of volume. At the speculative end, the list is dominated by low-float, high-risk penny stocks. Look at Net Capital Inc., NCPL, with 244.7 million shares traded and an astonishing one-day gain of over 126%.
That's classic high-risk retail money chasing explosive volatility.
Yeah.
It just shows that speculative interest in these low-priced assets is still a defining feature of this market cycle.
Now, contrast that speculative fraught with the institutional tier. NVIDIA, for instance, traded 86.6 million shares.
That's not random.
Not at all. That kind of volume reflects necessary large-scale institutional portfolio rebalancing, hedging, and position adjustment ahead of the binary Fed event. When a giant like NVIDIA trades over 80 million shares, it signals major money moving with conviction.
And Tesla was active too.
Tesla, TSLA, saw 37 million shares traded and showed strong positive momentum, closing up 2.5%. That kind of accumulation points to high conviction risk initiation by large funds.
I found the standout gainers list for December 9th particularly telling. It was heavily skewed toward biotech and pharma, often driven by these binary news catalysts.
Yes, the source material highlighted a remarkable cluster performance. Fulcrum Therapeutics, FULC, up almost 46%, Bora Biopharma, VOR, up over 30%, and Structure Therapeutics, GPCR, just soaring, up 102%.
A double in one day.
This specific cluster is fueled entirely by clinical catalysts, positive drug trial data, accelerated regulatory pathways, M&A speculation. These are not slow grind trades. They're event-driven, high-risk, high-reward bets that can double or zero out in a single session.
And meanwhile, the core AI thesis just grinds higher.
Steadily. Semiconductors, insulated from immediate Fed concerns, saw Micron up over 4% and Broadcom adding almost 3%, reflecting that deep anticipation ahead of their earnings reports.
And to give you, the learner, the necessary perspective, we should probably touch on the extremes, the parabolic YTD gains and the recovery opportunities.
It's necessary context, yeah. The YTD extreme gainers show you the pockets of maximum euphoria. We saw Regencell Bioscience, RGC, up an unbelievable 12,669% year to date.
That's not a typo.
Not a typo. These are purely parabolic, low-float phenomena. They contrast so sharply with the disciplined, fundamentals-based growth that defines the T-KIF strategy. They serve as a reminder that liquidity and speculation can create gravity-defying moves.
On the more stable side, we saw companies like Bel Fuse and Kellanov hitting 52-week highs, showing the persistent strength in niche areas like electronics and consumer staples.
And on the flip side, we saw clear potential recovery plays emerging from the 52-week lows list. It suggests capital is hunting for deep value. Smart Sand, S&D, was up a whopping 155% from its 52-week low.
Raw stores, too.
Ross Stores, RS Star, showing strength, up over 45% from its lows. These examples suggest a recovery mode is starting in areas that were highly beaten down earlier in the cycle.
Okay, now we enter the heart of it, the tactical intelligence. The KING-KAMBUF reserves a proprietary strategy for Market Week 50 in Q4 2025. This is where we translate all those observations into actionable position management.
The overarching strategy framework, and this is detailed in their report, #03, it's built on highly disciplined, risk-defined momentum trading. Their target is explicit.
Achieve a focused 3% portfolio return this week. That's not a moonshot.
Not at all. It's a systematic, achievable goal. It's about minimizing unnecessary exposure right before the Fed.
And their primary methodology is trend continuation entries.
Yes, they're only initiating entries that align with the key short and intermediate term moving averages. So the 10-day, the 20-day, and most importantly, the 50-day moving average.
And for you listening, these moving averages act as dynamic support levels. They define the health of the current trend.
If the price holds those levels, the trend is robust. Simple as that.
And what's the absolute core rule that defines their strategy bias right now?
The core rule is the bedrock of their discipline. Long only while the price is above a rising 50 DMA. This ensures they are never, ever fighting the intermediate trend.
Their bias is crystal clear.
Buy pullbacks, not breakdown rebounds. They're looking for those shallow corrections within established upward trends. That moment, a stock pulls back to dynamic support and bounces. They're not interested in trying to catch a falling knife.
It's about capturing the momentum of institutional flows with reduced risk.
Exactly, not trying to predict a capitulation bottom. And that strict discipline extends to risk management. The report sets a remarkably tight risk profile.
Defined risk per position at a very small 1 to 1.5%.
With a portfolio max drawdown of only 3%. This is so critical when you're entering pre-Fed volatility. It means they're allocating small amounts of capital to each position, ensuring that even if the Fed delivers a complete shocker and hits all their stops, the maximum loss is strictly controlled.
Okay, let's pivot to their forward positioning. The T-KIF 20+ index is in a significant expansion phase. They're building towards 100 names. And we have 5 important new names added as of December 5th. This is the roadmap.
And these additions, they strongly reinforce that AI thesis while deliberately building that defensive counterbalance we saw in the Deccan ninth rotation.
Let's dive into the AI and data infrastructure reinforcement first. We have Western Digital, Seagate, and Micron.
The addition of these 3 is not trivial. It shows a belief that the AI trade is moving beyond just the chip designers like NVIDIA and into the data storage and memory architecture that supports them.
Right. WDC and STX are massive beneficiaries of data center construction.
And Micron's addition is perhaps the most strategic. It signals that the market and the T-KIF framework is explicitly repricing DRAM and HBM high-bandwidth memory as a strategic bottleneck for AI deployment.
If every AI server needs high-speed memory, the supply chain for that memory becomes a high-conviction trade.
It does, but then they make what seems like a contradictory move, adding high-beta risk indicators like Robinhood.
Yeah. This is the calculated risk-on signal. HOOD, up over 230% YTD, is explicitly linked to increasing risk-on sentiment and renewed retail trading activity. It acts as a kind of risk thermometer inside the fund. When HOOD is added, it signals management believes the underlying psychological conditions, the hunger for risk, are robust enough to support momentum trading.
And then the ultimate counterposition, Newmont Corporation, NEM. A gold miner.
This is the genius of that barbell strategy in action. NEM provides the crucial hard asset hedge. Gold miners benefit from macro hedging flows and currency volatility when equities wobble or if geopolitical risk spikes.
So they're creating a stronger internally hedged portfolio.
You got it. Explosive growth in AI and fintech on one side, and the defensive gold miners acting as an internal shock absorber on the other.
This raises an important question for you then. If TKIF is adding high beta momentum like Hood and depth defense like NEM at the same time, isn't that a mixed signal? Are they betting on roaring growth or hedging an imminent slowdown? It's not confused, it's calculated. They are acknowledging that the market is in a high valuation environment where volatility is cheap, VIX at 16.93, but the risk of a surprise is high.
The Fed.
The Fed. They're betting that the AI names will outperform, but they are protecting the portfolio capital against the unanticipated macro event, a geopolitical flare-up, a shocking Fed statement that could temporarily crater the tech leaders.
So they're managing for two simultaneous realities: long-term AI success and short-term macro fragility.
Exactly.
The strategy also carefully diversifies risk across the major indices through specific portfolio weighting, ensuring index representation protects against concentrated risk.
Right. They allocate 40% to the S&P 500, focusing on quality and earnings visibility. These are your core stability plays like Eli Lilly, Visa, United Health.
Predictable, strong cash flows.
Then the Nasdaq Q gets 35% weight, focusing on growth reacceleration. Examples being Alphabet, ASML, the essential chip equipment maker, and CrowdStrike. These are controlled risk, momentum drivers central to the AI and cloud story.
And the Dow gets the final 25%, primarily for capital preservation.
Yep. The Dow acts as the capital preservation and slow grind higher bucket. It includes stable names like Microsoft, Goldman Sachs, Home Depot. And the report specifically notes ExxonMobil, XOM, as an entry point at the rising 20 DMA.
Capitalizing on geopolitical stability and seasonal energy demand.
Fits perfectly into that defensive, industrials-focused side of the portfolio. This ensures the whole thing benefits from multiple diversified flows.
This is the operational core of the report. The highest confidence short cycle trades. The 1 to 5 day swings identified for this week, complete with price discipline. This is the TKIF mandate in action.
And we have to define the structure here. When we talk about targets, the TKIF methodology uses L1, L2, and L3. For you, the learner, think of it this way. L1 is typically the first 1 and 1.5% profit target.
And that's where you scale out.
You scale out 50% of the position and critically move the stop to break even. L2 is the next profit level, scaling out another 25%. L3 is the full target, the high conviction exit zone.
So it's systematic profit taking, essential for a volatile environment.
Let's start with the absolute top conviction trade of the week. It gets a perfect 5-star rating and the label strongest buy. That is Micron Technology MU.
Confidence level is sky high at 90%.
And the risk-reward ratio is exceptional at 1 to 3 or better. The current price is $246.92. The strategy sets the primary entry zone right near that dynamic support between $240 and $245.
With a very tight hard stop at $235.
And the target ambition is aggressive, stretching all the way up to $265.
The catalyst here is what makes it a 5-star pick. It's a leveraged bet on upcoming corporate validation.
Correct. The thesis is that AI chip demand will be confirmed by the anticipated validation from Broadcom's earnings later this week. Because MU is a fundamental supplier, the memory bottleneck, it offers the best leveraged exposure to a positive Broadcom report without needing to hold Broadcom's higher valuation through the announcement.
So it's the best trade opportunity of the week.
Contingent on that semiconductor narrative holding up, yes.
Next, we move to Broadcom, AVGU itself. A 4-star strong by Y with 88% confidence. Current price is $401.10.
This one requires nerves of steel. Because the earnings report is this week, it is a critical, high-impact event that will define the semiconductor group's forward path.
The entry's tight, $395 to $400.
And the hard stop is $385. Targets go up to $425. If Broadcom delivers robust AI infrastructure guidance, this move validates not just AVGU, but the entire TKIF semiconductor cluster. The risk here is just binary outcome management.
Moving to the largest name in the index, NVIDIA. Rated a 4-star BUY at 85% confidence. It's currently trading around $184.94.
And the report explicitly notes this as the most conservative option among the 5.
Why is that?
Because of its immense size and that concentration risk we talked about. The entry zone is $182 to $186, buying a shallow pullback. The stop is set structurally wide at $175. That's a key technical support level the strategy doesn't believe will break easily.
Target stretch up to $205.
And the primary catalysts are structural. The recent China H200 sales approval supports medium-term revenue, and the market generally avoids putting significant pressure on NVDA right before a major macro event like the Fed.
Then we hit the high beta EV giant, Tesla, TSLA, which closed up 2.5% on Tuesday. Strong daily momentum, This is a 4-star strong buy with 87% confidence.
Tesla is a classic high beta stock. It acts like pure momentum and sentiment fuel. It requires extremely tight management, especially heading into Fed Day, because its swings are massive.
The entry is $425 to $450.
Capitalizing on Tuesday's momentum, the stop loss is set very tight at $438. Target stretch up to $480. The thesis relies on that strong daily momentum and the continued narrative of an EV market recovery. This one will require immediate position scaling once L1 is hit to minimize exposure.
Finally, we have Palantir Technologies, PLTR, another 4-star BUI with 82% confidence, representing the defense and government AI play.
Palantir is a key beneficiary of both AI adoption and increased government defense spending. The entry zone is a bit wider, $55 to $58, with a hard stop set structurally at $50.
Target zone is aggressive, up to $70.
This trade just capitalizes on the consistent stream of government contracts and the secular growth narrative around specialized AI services. It's an effective way to ride the defense budget tailwinds alongside the tech momentum.
As we've established, understanding the individual trades is only half the battle. The KING-KAMBUF strategy mandates managing positions not in isolation, but as specialized clusters,
which allows for dynamic, real-time risk allocation based on thematic momentum.
So let's review those in-play cluster strategies, starting with the highest momentum and highest conviction group, the semiconductor cluster.
That includes our top picks: MU, AVGO, NVDA, and Lam Research LRCX. The technical momentum here is strong bullish. It's exhibiting a clear higher lows pattern.
And for you, the learner, an HHL pattern confirms an established healthy uptrend. Pullbacks are consistently higher and rallies push past previous highs.
So the strategy is to buy confirmed breakouts on high volume and target those multi-level profit takes L1, L2, L3. This cluster is expected to perform best if the Fed is accommodating or neutral.
Then we have the high-octane event-driven biotech pharma cluster, which dominated Tuesday's gainers: FULC, VOR, GPCR, and IMEP.
Momentum here is categorized as very strong bullish. It's driven purely by those binary clinical catalysts. The volume is exceptional, often 15 to 30 million shares daily.
The strategy is clear. Ride the momentum,
but acknowledge the astronomical risk. The report specifically warns that this is a high-risk area. The outcome of those clinical trials can lead to an immediate 50% gain or a 50% loss. FULC, which spiked almost 46% today, is the identified highest risk, highest reward play in the whole portfolio.
And finally, the stabilizing factor, the clean energy cluster: P-Plug, ONDS, BYND, and SMR.
This cluster has moderate bullish momentum. It's not driven by immediate earnings or AI, but supported by long-term environmental policy tailwinds and a structural recovery. Plug Power, PL, volume is highly elevated at over 53 million shares, indicating strong retail and potentially institutional interest.
The strategy here is focused on disciplined 2,000-day swing trades,
buying defined support levels in these recently beaten-down policy-supported stocks.
Okay, the most important section right now, with the clock ticking down to the Fed, is risk management and Fed day tactics. How does the KING-KAMBUF reserve instruct traders to handle the inevitable volatility coming tomorrow?
Execution discipline is paramount, especially entering Wednesday afternoon. First, they review position sizing, strictly. They explicitly tell you how to allocate capital based on risk appetite.
For example,
an aggressive account might place 8% of total capital in NVDA and 6% in MU. A conservative account would have those allocations. This ensures capital protection is baked into the initial position size.
And once the position is entered, stop-loss discipline is rigid. It's more than just a hard stop.
Absolutely. The strategy mandates the use of hard stops non-negotiable, but the most crucial tactical rule is automatically moving that stop to break even after the first profit target, L1, is hit.
You protect your capital first, then your profits.
You turn a risky trade into a risk-free trade, ensuring you lock in some gains regardless of what the Fed says.
And what about that critical window between Wednesday morning and the 2.0 p.m. announcement?
The tactical read is unambiguous. Do not introduce fresh risk on Wednesday morning. Treat tomorrow primarily as an exit and risk reduction day, not a new position day.
So if you're up, you take the money.
If your long positions are near or above that 1 to 1.5% gain before the announcement hits, that is the natural scale out or full profit take zone. You never gamble on a headline. The market rewards discipline, not impulse.
Let's bring this analysis home and summarize the lessons we've extracted from the Reserve of KAMBUF report for you today. We're sitting in a market defined by extreme caution, leading to these mixed closes.
Yeah, the Dow is suffering from old economy financial fears, driven by JPM.
But tech and AI still drive the index, showcasing the dominance of that secular growth story. Volatility is moderate, signaling high anticipation, not outright panic.
The key takeaway is just the absolute requirement for precision. In position sizing, in risk management, we're in a unique spot where macro decisions and immense sector concentration are amplified. Every action has these outsized index consequences.
So what does this all mean for your broader investment framework as you navigate the coming weeks?
We can distill the KMBUF analysis into 3 final points for you to carry forward. First, Fed decision is the gravity well. Everything hangs on tomorrow's rate decision and, critically, the 2026 guidance.
The market's path of least resistance is upward only if that guidance confirms a continued cautious path to lower rates.
If Powell tempers easing expectations, high valuations will correct, and they will correct rapidly. Second, AI is the long-cycle story, but storage is the new bottleneck. The strategic additions to the TKIF index Micron, Western Digital, Seagate prove that institutional focus is fixed on AI infrastructure. But they're now betting on the memory and data storage bottleneck as the high-leverage growth area.
Moving beyond just core GPU processing. And third, and this is the most important, discipline over impulse. Short-cycle trading must align with that long-cycle trend and, above all, must employ defined mechanical hard stops and disciplined profit-taking. The L1, L2, L3 structure preserve capital at all costs going into known binary risk events.
That brings us to our final provocative thought for you to consider as the Fed meets. The market is currently priced for ongoing, highly optimistic AI-driven growth. This means expectations are baked in at near perfection for companies like NVIDIA and the other concentrated Magnificent Seven names.
The bar is set incredibly high.
So this raises an important question for you to mull over. If the Fed confirms the soft landing with the expected mild cut, does the market reward AI leaders further, pushing them into new, higher valuation territory?
Or do those already sky-high valuations mean that the sector is now less forgiving of even a minor disappointment?
Turning what would historically be future earnings beats into a classic sell-the-news event.
The market's reaction tomorrow will tell us whether current exuberance has room to run based on fundamentals, or if the sheer gravity of valuation is about to win out over momentum. It's a question of forgiveness and how much is left in the tank.
A fantastic framework for tomorrow's monumental decision. Thank you for joining us for this in-depth analysis of the Reserve of Terry MBF Financial News and Reports Magazine Daily Report. We encourage you to apply this detailed structure to your own learning and research as you navigate this highly critical market week. We'll talk to you next time.